risks emerging for the dollar. Prestige Economics President Jason Schenker joins us now from Austin. Jason, always great to have you. So even as we see some of the credit risks, some of the banking risks be alleviated, at least for now, that we know of, does the fact that the Fed has said that they will have to keep tightening have any meaningful impact anymore when it comes to the momentum trading that we see in the dollar?
Well, it might have a little bit of an impact here, especially if we look at the fact that now there's a higher probability of a June rate hike. That I think has a lot to do with concern about the core CPI year-on-year number, which actually accelerated in March from 5.5 to 5.6%, underscoring a risk that the IMF called out last week in the World Economic Outlook that CPI could be at risk of plateauing across economies. And so for that core inflation number, that's, I think, something the Fed's going to be watching closely. They might have a couple more rate hikes or more in them, but no matter how you slice it, we're pretty close to the end of the tightening cycle, whether it's 1, 2, 3 more rate hikes. We're almost there. So while there might be a little bit more upside for the dollar right here as we see those things get priced in, if we look later in the year, you're going to see then, I think, rate cuts begin to get priced in, the timing of that, and that could weigh on the greenback.
Of course, the Fed story, the US story, banking is one side. The other is really how much the countercyclical impact of the China recovery can come into into play here. So when you're taking a look at the big tranches of data we're expecting from China this week, what are you watching out for, particularly as it has the ability to really affect global commodity markets and where oil goes from here?
On the one hand, there's going to be, I think, a big focus on the China GDP number, a question of how is growth doing? How is the Chinese economy recovering now that the zero COVID policy is in the rear view? That's something that's going to be very important for commodity prices especially. But I think people are going to be watching for those next round of Chinese PMIs. I think specifically the Caixin manufacturing PMI, which fell to 50. It was a surprise on the downside at a break-even level for the month of March. We won't get that for a little while yet, but that's what people really watch for implications of commodities going forward. And the US and Eurozone PMIs, US ISM, Eurozone manufacturing PMI, those are likely to be below 50 again for the month of April. So I'm concerned about what that could do for the metal side of things. But for oil prices, for example, the biggest factor really is that OPEC cut production. They announced that May 1st production cut. It was a surprise a couple of weekends ago. And that's something going into the US summer driving season that could present upside risk for oil prices, which they've risen since that announcement. And in the US, we still have really robust jobs data. The JOLTS job openings numbers show there's currently over 9.9 million open jobs even now. And we look record level of labor force and a record level of payroll numbers. Job market strong. The wages have never been this high. So things look really good for the labor market. That means it could send oil prices higher in the summer, regardless of what's going on in China.
Jason, so when you're talking about being concerned about metals, you're thinking more industrial metals, because we're seeing precious metals being loved right now.
Yeah. So the industrial, I'm talking specifically, and really if we want to take a closer look at it, it's probably going to be on the non-ferrous side, because non-ferrous metals tend to trade pretty liquidly. And so if we see weakness in China, that's where we see weakness. But the precious metal side, especially gold prices, that's up on a number of factors, right? We've seen a little bit of weakness in the dollar. We've got concern about banking, concern about global growth, concern about CPI. And then there's everything going on with Cold War II in the background that's also been supporting the price of gold. Those factors aren't likely to go away anytime soon.
How is the war in Ukraine impacting U.S. nat gas prices at the moment?
Well, nat gas prices have come under a lot of pressure recently. It's much less of a factor than it was last year. That has a lot to do with Europe putting caps on those nat gas prices. But we'll see what happens throughout the year ahead. But we've seen Europe now using more coal. They put a cap on some of those prices. So I think that's something that could keep U.S. nat gas prices under pressure, especially because U.S. inventories in nat gas have improved significantly from where they were last year.
Prestige Economics President Jason Schenker, great to have you back. Thank you.